Look at the chart on your screen right now. I want you to ignore the price for a moment and focus solely on the line. Look at that massive vertical wick sticking up from the top of the candle like a jagged needle. In the world of high finance, that is not just a statistical anomaly, that is a crime scene. In a single trading session, the price of silver flashed to $83.71. It did not drift there. It did not climb a ladder of buyers and sellers. It teleported. 1 minute, the market was trading calmly at $79. The next minute, it surged to $83. And then, just as suddenly as the move began, the rug was pulled. The price collapsed from $83.71 all the way down to $74.47. That is a $9 swing in the blink of an eye. If you are a new investor, you are likely feeling a sense of pure terror. You are looking at that red drop and thinking the rally is over, that the bubble has finally burst, and that you have been caught at the top. But if you are a veteran, if you are someone who has survived the volatility of 1980 or the silver crash of 2011, you know exactly what this is. This was not a market failure. This was a stop hunt. What we witnessed was a calculated algorithmic attack designed to wipe out the leveraged traders who chased the gap on Sunday night. The big banks and institutional players saw the liquidity drying up during this final week of the year. They saw that the order book was hollow. So they allowed the price to run up to $83 to suck in the retail FOMO money, those who were desperate not to miss the boat. When the trap was full of leveraged long positions, they slammed the door shut. In this deep dive analysis, we are going to perform an autopsy on this $9 swing. We are going to examine the anatomy of a rug pull and explain why this violent volatility is actually a healthy sign for the long-term trend, even if it feels like a heart attack in the moment. Most importantly, we will show you why the physical price of silver did not drop $9 today. While the paper market is whipping around like a flag in a hurricane, the flagpole of physical metal remains rock solid. This is the story of the Monday rug pull, a tactical maneuver in a much larger strategic war for the future of the monetary system. We are entering a phase where the weak hands are being forcibly removed to make way for the real move in January. To understand how a $9 drop is even possible in such a short window, you must understand the environment we are currently in. We call this Ghost Week. It is that eerie period between Christmas and New Year's Day when the titans of Wall Street are away from their desks and the massive liquidity that usually stabilizes the market evaporates. Most institutional trading floors are running on skeleton crews, or more accurately, they are being managed by automated algorithms with very wide parameters. In a normal trading week, the order book is thick. If a bank wants to sell a massive block of silver, there are thousands of buyers waiting at every cent of the way down to absorb that sell pressure. But during Ghost Week, the order book becomes hollow. It is like a forest where the trees are spaced very far apart. If you throw a stone, it can travel a long distance before it hits anything. The banks know this. They understand that during these low-volume hours, especially on a Sunday night or a Monday morning, it takes very little capital to move the needle. This lack of liquidity creates what we call air pockets. When the banks initiated their sell orders at the $83 peak, there were no significant buy orders sitting at $82, $81, or even $80 to stop the fall. The price simply fell through the floor until it hit a zone where buyers were actually standing. This is why the move feels so violent and unnatural. It is not a reflection of a change in the fundamental value of silver. It is a reflection of a broken mechanism. The banks use Ghost Week as a hunter's season. They know that retail investors are often distracted by holiday celebrations, but their stop-loss orders are still sitting in the system, visible to the exchange computers. By pushing the price into these air pockets, the banks can trigger a massive cascade of automated selling without needing a real reason. They are hunting for liquidity in a desert. They create the volatility, they harvest the panicked positions, and they reset the board before the real volume returns in the first week of January. If you are holding physical metal in your safe, this Ghost Week volatility is nothing more than a phantom. But if you are playing in the paper casino with borrowed money, the ghosts are very real, and they are coming for your collateral. To understand why silver dropped from $83, you have to understand who was buying at $83. It was not the smart money. The smart money bought at $30. They bought at $50. The people buying at $83 on a Sunday night gap open were the chasers, the crowd driven by the fear of missing out. These are the traders using 10 times or 20 times leverage because they wanted to turn a small account into a fortune overnight. They saw the vertical move and thought the train was leaving the station forever. The big banks possess a massive advantage in this game. They have the data. They can see the aggregate levels where these retail traders place their stop-loss orders. A stop-loss is an automatic sell order that triggers if the price drops to a certain level to prevent further losses. Most people who chased the price up to $80 placed their stop-losses at $75, which was a psychological support level. The banks simply engineered an environment to reach that level. They sold a massive block of futures contracts at the high, which acted like a heavy weight on a scale. As the price was pushed down to $79, then $78, it eventually entered the stop-loss zone at $75. Snap. Thousands of retail sell orders fired simultaneously. This created a selling waterfall, a self-reinforcing loop where selling triggered more selling. The price plummeted to $74.47 solely because of these forced liquidations. There were no humans making decisions at $75. There were only machines executing orders. And guess who was waiting at $74 to buy it all back? The very same banks that sold the top at $83. This is a classic market maneuver known as rinsing the leverage. It is brutal. It is arguably unfair, but it is how the market clears out the gamblers before the next legitimate leg up. By forcing the weak leveraged hands to sell at the bottom, the banks essentially transferred the coins from your pocket to theirs at a $9 discount per ounce. They sold high, forced you to sell low, and then pocketed the difference. This process cleanses the market of excess speculation, ensuring that when the price moves to $100, it does so on a foundation of strong hands rather than fragile debt. While the paper price was crashing $9 in a single session, a fascinating phenomenon occurred. If you had walked into a local coin shop or logged onto a major bullion dealer's website during that crash, you would have noticed something strange. The prices for physical silver eagles, maples, and 100-ounce bars did not drop by $9. In fact, most dealers kept their prices exactly where they were when silver was at $80. Some even raised their premiums. This is the single most important signal for a serious investor. The spot price crashed, but the street price held firm. Why? Because physical dealers understand that the paper volatility is an illusion. They are not willing to gamble with their hard inventory based on a computer algorithm's mood swings in a hollow market. If a dealer sells you a silver eagle at $75 and the price snaps back to $80 an hour later, they have just lost $5 of real wealth. They treat physical metal as a stable store of value, while treating the COMEX paper price as a broken casino. This divergence proves that the dip was a paper event, not a physical one. In a real bear market or a genuine collapse in demand, physical investors would be lining up at shops to dump their bars in a panic. But we saw the opposite. We saw holding. We saw strength. There was no flood of physical selling. There was only a computer algorithm dumping futures contracts to trigger stop losses. The foundation of the silver market is made of solid concrete, even if the paper roof is shaking violently in the wind. If you were waiting for this $9 dip to buy physical silver, you likely found that the window of opportunity was open for perhaps 15 minutes. During those minutes, dealer websites were likely crashing or showing out of stock. This is the reality of the physical market. When the paper price becomes too disconnected from reality, the physical supply simply vanishes. You cannot buy what is not there. This divergence tells us that the smart money is not selling their metal. They are simply watching the paper traders burn. While the retail crowd was panicking and the speculators were getting liquidated, another group of players was watching the screen with a very different emotion. Excitement. These are the industrial whales. Imagine you are the procurement manager for a global solar panel manufacturer or a high-tech firm like Tesla or Samsung. You require thousands of ounces of silver every month to keep your production lines running. You have a strict budget, and you have been watching the price climb toward $85 with growing concern for your profit margins. When you saw the price hit $83 on Monday morning, you were likely preparing to tell your board of directors that raw material costs were going to bite into the quarterly earnings. But then, the rug pull happened. As the price plummeted to $74.47, did these industrial giants panic? Absolutely not. They celebrated. They saw a $9 discount handed to them on a silver platter by the bank manipulation. The procurement managers hit the buy button on their hedging software instantly. This $9 drop was a gift to the industry. It allowed them to secure physical delivery contracts at a significant discount before the end of the year. They used the bank's tactics against the banks. While the banks smashed the price to clear out the small gamblers, they accidentally opened a door for the industrial users to step in and grab cheap inventory. This is precisely why the price bounced so hard from $74 back up to $78. The industry stepped in. They absorbed the paper selling and converted those paper contracts into actual physical delivery requests. This creates what we call a higher low. Last week, the floor for silver was $65. This week, the new floor looks like $74. We are building a staircase. The steps are getting steeper, but the direction remains the same. Up. The industrial bid is the ultimate safety net. Samsung and Tesla did not chase the price to 83. They waited for the blood in the streets, and they scooped it up. In the long run, the industrial demand for silver is far more powerful than any bank's short-term manipulation. To truly understand the chaos of a $9 swing, we must consult the history books. History does not repeat itself, but it often rhymes, especially in the precious metals markets. What we saw today is almost a mirror image of the price action during the legendary silver runs of 1980 and 2011. If you study those periods, you will see that vertical moves are always followed by violent corrections. In 1980, when the Hunt brothers were cornering the market, silver did not just glide to $50. It moved in massive, heart-stopping lunges. There were days when the price would drop 20% in a single session, only to recover and hit new highs a week later. The volatility was the tool used by the exchanges to change the rules and force investors out of their positions. Today, the banks use algorithms instead of rule changes, but the goal is the same: to shake the confidence of the masses. Think back to early 2011. Silver was charging toward $50 an ounce. The excitement was palpable. Then, in what became known as the May Day Massacre, silver dropped over $6 in a matter of minutes during the thin liquidity of the Asian trading session. The headlines shouted that the silver bull market was dead. Many retail investors sold everything in a panic at $35. Yet those who understood market structure knew it was a tactical strike to protect the short positions of the massive bullion banks. These historical echoes teach us one vital lesson: volatility is the price of admission for a silver bull market. You cannot have the 500% gains without enduring the 30% drawdowns. The $9 drop we just witnessed is a signature of a parabolic phase. It confirms that we are no longer in a boring sideways market. We are in the end game of a debt-based monetary system. In 1980 and 2011, silver was a warning signal. In 2025, with silver trading near $80, that signal is screaming. The banks are fighting harder because the stakes are higher than they have ever been in human history. While silver is whipping around like a wild animal, we must look at its older, more stable sibling, gold. On this volatile Monday, while silver was flashing a $9 swing, gold was trading at $4,514. It was down slightly, by perhaps $4 or $5, but that is the definition of stability. In a market where one metal is having a heart attack, the other is sitting calmly at all-time highs. This tells us everything we need to know about the underlying health of the monetary system. Gold is the anchor. It is the primary asset that central banks and sovereign nations use to hedge against currency collapse. As long as gold holds the $4,500 level, the floor under silver is secure. Silver is simply acting like the high beta version of gold. It overshoots to the upside when people are excited and overshoots to the downside when they are afraid. To understand the value proposition here, we must look at the gold to silver ratio. At the morning peak of $83, the ratio dropped into the 50-to-1 range. At the bottom of the crash, at $74, it expanded back towards 60-to-1. Now at $78, we are sitting around 57-to-1. This compression is a massive signal. Historically, in the early stages of a bull market, the ratio sits at 80-to-1 or higher. When it begins to collapse toward 50, 40, or even 30, it means silver is finally outperforming gold on a percentage basis. The fact that gold is holding $4,500 proves that the monetary premium is still very much alive. Silver just got a little ahead of its skis this morning. It ran too fast and too far for the current amount of paper liquidity. Gold is the adult in the room saying, "Calm down, we are going higher, but we must do so with a solid foundation." If you were worried about silver's $9 drop, look at gold. If gold isn't panicking, you shouldn't be either. The anchor is set, the floor is solid concrete, and the trend remains undeniably bullish. Let us look closely at the chart pattern formed by this $9 volatility. Technically, the candle created on Monday is known as a shooting star or a high wave candle. It is characterized by a small body at the bottom and a very long upper wick reaching toward the sky. In a vacuum, a shooting star represents rejection. It means the market tried to push to $83, but the sellers were so aggressive that they forced the price back down. Usually, a shooting star signals a pause in the uptrend. It means the buyers are temporarily exhausted. They ran up the hill too fast and they are now out of breath. We should expect the price to consolidate here for a few days. Do not expect another straight vertical line tomorrow. The market needs time to digest this $9 meal. We will likely see silver chop around between $75 and $80 as the dust settles. However, context is everything in technical analysis. A shooting star at the end of a long, tired bull run is a sell signal. But a shooting star at the beginning of a massive breakout, driven by a holiday liquidity vacuum, is often just a liquidity test. The market was checking to see where the real sellers were hiding. It found them at $83. This creates a temporary resistance zone, but it also creates a target. The market has a habit of eventually returning to fill those long wicks. Look at the closing price relative to last Friday. We closed Friday at $71.91. Even after the crash from the highs, we are trading around $78. That means we are still up nearly 10% in a single week. If you ignore the wick, if you ignore the $83 flash, this is still a massive green day. The trend is still pointing up. The breakout is still valid. The only thing that has changed is that the easy money phase is over, and we have now entered the volatile grind where only those with strong conviction will survive. As we approach the final hours of the trading year, we must look beyond the daily noise and focus on the tidal wave of capital preparing to enter the market in January. In the world of finance, this is known as the January effect. It is a period where investment appetite resets and billions of dollars in new capital are allocated to the best performing assets of the previous year. And in 2025, silver has been one of the top performing assets on the entire planet. One of the most significant shifts occurring right now is the entry of institutional capital, specifically from pension funds. Historically, these massive funds, which manage trillions of dollars for retirees, have avoided precious metals in favor of stocks and bonds. But the landscape has changed. With global inflation persisting and traditional bond yields failing to protect purchasing power, pension funds are being forced to diversify into hard assets. For example, India's pension regulator, the PFRDA, recently updated its guidelines to allow funds to invest in silver and gold exchange-traded funds. Similar shifts are occurring across Europe and North America as managers realize that a portfolio without precious metals is a portfolio at risk. The $9 rug pull we witnessed today actually makes silver more attractive to these institutional buyers. If you are a pension fund manager with a mandate to buy $1 billion worth of silver in January, you do not want to buy at a vertical peak of $83. You want to buy at a discount. By flushing the leverage and bringing the price back down to $78, the banks have essentially cleared the runway for these heavy institutional jets to land. These are not day traders looking for a quick flip. These are long-duration holders who buy and hold for years. When they enter the market, they absorb the physical supply and move it into deep storage, further tightening the structural deficit. The monthly close on December 31st is the ultimate signal. If silver closes above $75, it will print the highest monthly and yearly close in history. This will trigger the algorithms of every major fund in the world to start buying on January 2nd. The rug pull was a painful test for retail speculators, but for the incoming wall of institutional money, it was an invitation to a fire sale. We are wrapping up the most volatile day of the year, and we have reached the final chapter of this investigation. We have dissected the flash smash that took silver from $83 down to $74 and back to $78. We have exposed the bank-driven stop hunts, analyzed the physical resilience of the street price, and looked at the massive industrial bid that provides a floor for this market. Now, you are left with a portfolio that might look like a battlefield. The volatility today was enough to give even a seasoned trader motion sickness. But if you are still here, if you did not sell at the $74 bottom, you are a survivor. In a bull market, survival is the absolute prerequisite for glory. As we enter the final 48 hours of 2025, here is your end-of-year checklist to ensure you are ready for the graduation to triple-digit silver. Item 1. Audit your leverage. If today's $9 swing made you feel physically ill, you are over-leveraged. You have too much margin or too many short-dated options. Use the next 2 days to de-risk. Move some of that paper exposure into physical metal or fully paid mining stocks. The volatility in January will likely be even higher than what we saw today. You want to be in a position where a $10 drop does not force you to sell. You want to be unshakable. Item 2. Watch the $75 line. This is now your line in the sand. By bouncing off $74.47 today, the market confirmed that 75 is the new hard deck. As long as the price stays above this level, the breakout is intact. If we dip there again, it is a buying opportunity for the strong hands. If we break below it, we reassess. But right now, $75 is the fortress. Finally, ignore the intraday noise. For the next 2 days, the trading volume will be pathetic. Algorithms will paint weird candles, and spreads will be wide. Do not sit in front of the screen for 8 hours. Set a price alert and walk away. The chop is designed to steal your chips and break your spirit before the real move begins. I believe that the $83 peak we saw today is not a ceiling. It is a target. The market loves to fill these long wicks. I expect $83 to be taken out in the first 2 weeks of January as the pension funds begin their massive allocations. We are looking at a clear path to $100 in 2026. The physics of the silver shortage demand it. China's new export restrictions, the 5th year of structural deficits, and the explosion in solar and electric vehicle demand are creating a perfect storm. Today was scary. It was meant to be scary. If it was easy, everyone would be rich. The market forces you to earn your gains by enduring the volatility. You held the line at 74. You are still holding at 78. You have proven that you have diamond hands. Now relax. The year is almost over. You have positioned yourself in the only asset class that offers protection from debt collapse and exposure to the energy boom. Enjoy the new year, keep your stacks safe, and get ready. Because if you thought today was wild, wait until you see what happens when the real money shows up in January. The bull is alive, and it is just getting started.